Most people watching oil move right now think they're watching noise. The price ticks up. Social media panics for half a day. Then everyone resets, goes back to their lives, and waits for the next headline. But here's what they're missing, and I mean structurally missing, not just emotionally missing. An oil spike inside a debt-saturated global system is not a headline. It is a detonator. It reignites inflation psychology, corners central banks into a trap they cannot escape cleanly, and pulls capital toward hard assets with a speed that catches most people completely off guard. So I'm going to make a claim that sounds dramatic until you see why it's actually just arithmetic. If oil keeps climbing into this week, the probability of a sharp move in gold and silver rises dramatically, not because of fear, not because of hype, but because the global financial machine has been steered into a narrow corridor, and in that corridor most of the exits point in the same direction. This is not a prediction based on feelings. It is a mechanism based on stages. And once you understand the stages, you stop reacting like a spectator and start reading the system like someone who built it. Let's start with the one reality that makes everything else unavoidable. The modern world is not built on savings, it is built on promises, and those promises are measured as debt. When debt is low, inflation can rise and central banks can tighten without breaking much. When debt is high, inflation becomes radioactive, because the solution to inflation, which is higher interest rates, becomes the very thing that threatens the debt structure holding everything together. We are not in a low-debt world. We are in a world where the obligations are so enormous that stability is not just preferred, it is required. The machine can only keep running if energy stays manageable, trade stays relatively smooth, and financial conditions stay calm enough that debt can be rolled forward without triggering panic. That is why oil matters far more than most people understand. Oil is not just gasoline. Oil is transportation. Oil is logistics. Oil is embedded inside the cost of food distribution, the cost of shipping, the cost of every manufactured input. Oil is the cost of keeping the physical world in motion, so when oil jumps, it is not just a commodity chart moving. It is a price signal that floods through everything, every supply chain, every business, every household budget. And more critically, it moves through expectations. Because inflation is not just a number. Inflation is a belief system. It is what people think will happen to prices next. It is what businesses assume when they set prices forward. It is what workers demand when they negotiate wages. It is what investors fear when they decide whether to hold cash, bonds, or real assets. That is why an oil spike is so dangerous inside a fragile system. It does not need months to matter. It matters immediately because it changes what people believe is coming. And in a high-debt world, the future is the battlefield. Now here is what we are going to do. And stay with me here, because this is the moment in most financial discussions where things become abstract and people disengage. We are not going abstract. We are going systematic. I am going to show you a four-stage pattern that repeats across history with a consistency that feels almost mechanical. Then, I will prove it through three historical cases: real events, real decisions, real outcomes. Then, I will apply that exact same pattern to what is happening right now. And by the time we reach the present, the conclusion will not feel like opinion. It will feel like recognition. And then I will give you something practical: what to watch, what to avoid, and how to think so you do not get emotionally destroyed by volatility. Here is the four-stage machine. Stage 1 is the setup. A society or system builds obligations faster than its real productive capacity can support. It can be war spending, it can be entitlement promises, it can be corporate leverage, it can be housing bubbles or government deficits. The costumes change, the structure does not. The system becomes dependent on stable conditions to service what it has promised. Stage 2 is overextension. Institutions try to satisfy those obligations without admitting the real cost. They expand credit. They dilute the integrity of the currency. They suppress interest rates. They finance growth through borrowing rather than production. It feels like a solution because it postpones pain. But it makes the system more fragile because it deepens dependence on continued stability. Stage 3 is crisis. This is where reality punches through. An external shock or an internal fracture hits the system while it is already stretched. Often it is an energy shock. Often it is a geopolitical rupture. Often it is a banking stress. The signature is not the event itself. The signature is that policy tools start conflicting with each other. The system gets trapped between options that all carry serious costs. Stage 4 is the outcome. Credibility breaks, inflation accelerates or becomes structurally embedded. The public learns again that money is not a guarantee. Capital moves from promises to things, from financial claims to assets that are perceived as real. In modern regimes, this is where gold and silver reprice, because they represent stored value that sits entirely outside the credit chain. Now listen carefully to what I am not saying. I am not saying every cycle ends in hyperinflation. I am not saying the same chart repeats. I am saying the same logic repeats. A system that relies on stability, then overextends, then gets shocked, will face a credibility test. And credibility tests create demand for monetary alternatives. Every time. Let me prove it 3 ways. The United States in the late 1960s and 1970s. The setup. After World War II, the U.S. sat at the center of a global monetary system where the dollar was convertible to gold for foreign governments. It worked because America was dominant and because the world trusted the convertibility promise. But obligations expanded. Military spending rose. Domestic programs grew. The fiscal strain mounted, and foreign governments began quietly questioning whether those dollars could truly be exchanged for gold at the promised rate. The overextension. Instead of accepting the discipline of constraint, policymakers leaned toward accommodation. Credit expanded. The system tried to sustain both growth and promises simultaneously. Then came the pivotal moment, August 1971. Nixon ended gold convertibility and closed the gold window. The anchor was removed so the appearance of the promise could be maintained, even as the real constraint was abandoned. The crisis. Once the anchor disappeared, shocks hit harder. In 1973, OPEC's embargo sent energy prices surging. Inflation rose sharply. Growth slowed. The economy entered stagflation, that disorienting combination of high inflation and weak growth that destroyed the assumption that policymakers could simply fine-tune outcomes. The outcome. People began to understand that purchasing power could evaporate quickly. Trust in money became fragile. Gold, now freed from its fixed price, surged across the decade. Silver followed, sometimes explosively, during moments when confidence in policy control collapsed. The lesson is not nostalgia, it is mechanism. Obligations overextend, an anchor is removed, an energy shock lands, and hard assets reprice. Weimar Germany. This case is extreme. That is exactly why it is useful. It strips away the polite disguises and shows the structure bare. The setup. Germany emerged from World War I crushed by reparations obligations. What it owed bore no realistic relationship to what it could produce or tax without triggering social collapse. The overextension. To keep functioning, the government leaned on monetary financing. Workers were paid. Obligations were met on paper. The system kept moving. But monetary financing is not free. Every mark printed transferred cost into the currency's credibility. The crisis. As confidence cracked, people tried to get rid of money as fast as possible because holding it meant watching it disappear. Political instability and external pressure amplified the collapse. The outcome? Hyperinflation, savings destroyed, social order fracturing. People fled into anything that could hold value, foreign currencies, barter goods, precious metals when they could find them, because the domestic currency had stopped representing stored labor or stored purchasing power. The mechanism again. Obligations exceed capacity, expansion postpones the reckoning, shock collapses confidence, and capital flees into hard stores of value. The post-2008 global system. This one matters because most people watching this live through it, and it shows how the modern version of the pattern can appear stable while becoming progressively more fragile underneath. The setup. In the early 2000s, leverage built across housing, banking, and shadow banking. Asset prices inflated. Household, corporate, and government obligations expanded together. The system became dependent on rising asset prices and easy credit to maintain the feeling of prosperity. The overextension. After 2008, policymakers stabilized the system through rate cuts and massive monetary intervention. Quantitative easing became normalized. Markets absorbed a new operating assumption. Whenever serious pain appears, liquidity will arrive and absorb it. That belief created stability. It also quietly encouraged more leverage, because risk was not eliminated. It was postponed and concentrated. The crisis signals. The system periodically convulsed when liquidity expectations shifted. Sudden volatility spikes, funding stresses, inflation re-emerging in a way that forced central banks into the exact dilemma the setup had always been building toward. Tighten and risk breaking a leverage system. Ease and risk letting inflation expectations become permanently embedded. The outcome. In those moments, gold strengthened because it sits outside the promise chain. It does not require a borrower to pay. It does not require a central bank to maintain credibility. It simply exists. Silver followed, sometimes lagging, sometimes surging, because it straddles both monetary demand and raw commodity demand. 3 proofs. a major monetary transition, an extreme currency collapse, a modern debt and liquidity regime, different details, the same four-stage skeleton every time. Now we apply it to the present, step by step, like a checklist. Stage 1 today. We live inside a structure of obligations so large that the system requires continued rollovers, continued confidence, and continued stability in energy and trade. That is not ideology, it is math. Debt needs servicing. Servicing needs cash flow. Cash flow needs economic functioning. Economic functioning needs energy. And when debt is this high, the system becomes acutely sensitive to anything that raises costs or forces rates higher. Setup confirmed. Stage 2 today. Policymakers and markets have spent over a decade operating as though intervention is the default and stability is engineered. Even as inflation prints cool at the surface, the system remains one oil spike away from reigniting inflation psychology. And the danger is not just inflation itself. The danger is the response to inflation in a high-debt world. If rates stay tight, debt servicing costs rise and financial stress builds. If central banks ease too early, inflation expectations can reaccelerate and credibility erodes. There is no clean exit. Overextension confirmed. Stage 3 today. This is where oil becomes something more than a chart. An oil spike is a psychological weapon against credibility. It signals cost pressure returning. It signals supply vulnerability. It signals that inflation may not actually be finished. And when that signal lands on a public that already lived through the last inflation cycle, it does not take much to revive the fear. People start asking whether this is starting again. Businesses set prices defensively. Workers think about wages. Investors quietly rebalance. That is how inflation goes from being a statistic to being a mindset. And that is how oil can compress what should be a slow macro story into a fast repricing event. Crisis trigger confirmed. Stage 4 today, capital movement. When a system is pushed into a corridor where every policy option carries serious costs, capital seeks insulation. Gold and silver are classic recipients of that flow, monetary alternatives that do not depend on the same system that is under stress. Here is the corridor in plain language. If policymakers stay tight to fight inflation, financial conditions tighten, risk assets wobble, and safe haven demand rises. Gold benefits. If policymakers blink to protect growth and the debt structure, inflation risk rises and credibility risk rises. Gold benefits again. Gold does not need you to correctly predict which door policymakers choose. Gold tends to benefit when people realize there are only two doors, and both of them come with real costs. Silver, being thinner and more volatile, sometimes lags at first and then surges when monetary psychology spills into the broader metals space. That lag is not weakness. It is often the setup for the more violent move. So when someone asks whether gold and silver can break out this week, the analytically honest answer is a breakout becomes significantly more probable when oil-driven inflation expectations collide with a debt-saturated policy trap. Because that combination forces a repricing of what money is actually worth and what protection actually costs. Now, I want to give you something concrete so you know what to watch rather than just what to think about. There are two signals that tell you whether Stage 3 is converting into Stage 4 in real time. The first signal is bond market behavior. Watch whether inflation expectations embedded in bond prices begin rising again, not dramatically but steadily, as if the market is repricing higher for longer as the base case rather than a tail risk. When that shift begins quietly, the system is acknowledging the trap. The second signal is central bank language. Watch for the subtle but meaningful shift from confident to cautious. More references to being data-dependent, more emphasis on monitoring conditions carefully, more statements about commitment to the mandate. Commitment is what you emphasize when credibility is being tested. Confidence is what you project when it is not. When both signals appear while oil remains elevated or rising, you are watching the machine move between phases in real time. Now let me make this personal, because most macro analysis warns you about systems and forgets to connect it to actual human lives. If inflation pressure returns and the system tightens financial conditions, debt gets more expensive. Payments rise, businesses cut, hiring slows, risk appetite falls. People feel it in their monthly budgets before they see it in any headline. And if policymakers choose the other path, easing before inflation is truly dead, purchasing power declines, the cost of essentials rises, and ordinary people find themselves running faster just to stay in the same place. Either path carries a cost, and the cost lands on the people who are not positioned for it. This is why hard assets matter psychologically, not just financially. They represent an attempt to step outside the treadmill, to hold something that does not depend on the system's ability to keep its promises. Let me give you a quick reset so nothing gets lost. A four-stage pattern repeats across history. Setup, where obligations exceed productive capacity. Overextension, where institutions expand credit and delay the cost. Crisis trigger, where a shock exposes the fragility, and the outcome, where credibility tests drive capital toward monetary alternatives. We proved it through 3 historical cases. We verified every stage against the present. The conclusion is not optimistic or pessimistic. It is structural, because most people believe markets move because of news. Markets move because of constraints. News is simply the moment the public notices the constraint already exists. Before I close, let me collapse the 3 arguments people use to stay passive until it is too late. The first is that America is different and therefore exempt. America has genuine strengths. But arithmetic is not impressed by flags. A debt-based system is sensitive to rates, energy costs, and confidence in the currency. No nation, regardless of its history or dominance, is exempt from constraint. The second is that central banks can control this. Central banks can influence the cycle. They can delay outcomes. They can choose who feels pain first. But they cannot eliminate trade-offs. In a high-debt world, those trade-offs sharpen, tighten, and risk financial stress, ease, and risk inflation credibility. The third is that technology will solve it. Technology matters enormously over decades. Inflation psychology can reprice in days. Oil can reprice in hours. Policy credibility lives in the present tense, not in projections about future productivity. So here is how to actually think about this going forward. Stop watching price and start watching stage. If oil is rising sharply, you are watching a potential stage 3 ignition. You do not need certainty about the outcome. You need awareness of the mechanism. Do not wait for CPI to confirm what is happening. Consumer price data is a rearview mirror. Markets and expectations are forward-looking. By the time the data confirms the move, the repricing is often already half complete. Plan for volatility both directions. Gold and silver can move violently. The thesis can be structurally correct, and your timing can still be punished. The difference between disciplined positioning and reckless chasing is not conviction. It is risk control. Understand what silver actually is. Silver can underperform for weeks and then sprint violently. It is thinner, it is more emotional, it is more explosive, it attracts late momentum, and it can trap impulsive positioning. Treat it as a powerful instrument with real volatility risk, not a guaranteed payoff. Here is the final thought, and I want to say it as plainly as possible. When oil spikes inside a high-debt global system, it pressures inflation expectations. Inflation expectations pressure policy. Policy is trapped by debt. That trap increases demand for monetary alternatives that sit outside the system. Gold and silver reprice when the market collectively recognizes the trap is real. This is not a story about fear. It is a story about constraint, and constraint is what makes certain outcomes not just likely, but in some form, inevitable. Watch oil. Watch inflation expectations. Watch how central banks talk about what comes next. And most importantly, watch how quickly the market can flip from inflation is over to inflation might be back. Because that flip is the hinge. And when the hinge swings, gold and silver often move before the crowd understands why. Then people look back and ask how it happened so fast. It happened because the pattern advanced. And now you can see the pattern.